Welcome to our Taking Stock video for the week ending the 15th of September 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Welcome, Jace. How are you?
Very good, very good. Feel a lot better now that spring's come around, Kien.
Yeah, it's getting a bit warmer, isn't it? It's wonderful, but I've got a sense that hay fever's hit me a couple of times this week.
Oh, no.
But before we just get started, just a quick reminder that the information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile and any charts or tables we present shouldn't be relied upon as a guide for future performance. Well, Jace, inflation remains a key driver of the market this week, with US headline CPI rising faster than expected at 0.6% in August due to the increase in gasoline prices. But if we remove the volatile items like food and oil, the core CPI also increased by about 0.3% for the month.
Yeah, and it's a very good point as well, Ken. The chart on screen shows the annualized US inflation rate split between goods, which is in gray, and also services, which is in red. Notice how inflation across goods has actually fallen to historical averages, but services inflation remains stubbornly high, and rising wages and also rents have been the main contributors to this high services inflation.
Yes, stronger than expected inflation suggests that interest rates could stay higher for longer, and this has led to some selling pressure across growth stocks during the week, especially within the tech sector. Remember, growth stocks tend to have larger cash flows into the future, so the present value of these cash flows are more sensitive to changes in interest rate expectations, or otherwise known in finance as the discount rate.
And of course, this theme of higher interest rates for longer will also feed into the Australian economy, especially given that we're also experiencing pretty similar drivers of inflation, including wage pressures and also higher fuel prices as well. Higher interest rate expectations are expected to dampen consumer sentiment, which fell by 1.5% in September, and this could potentially lead to earnings downgrades across many consumer discretionary stocks. This is also the reason why we're cautious on this sector and the Australian economy as well.
No doubt, Jace, high interest rate expectations will lead to further corporate insolvencies in coming months. In August, we recorded 3 corporate failures. 2 of these businesses were trying to take advantage of consumer trends towards health and well-being. So very good stories here. You've got one called Wellfully, WFL is the code, and Halo Food Corp, or HLF. And both companies have never generated profits, relying on capital raisings to survive.
Yeah, that's right, Ken. So Wellfully didn't actually do too well. Excuse the pun. The other company to fail was Callium Lex, and this was a mining company who owned the potash project in WA. Now, for those that don't really know, potash is primarily used in agricultural fertilizer. So the company painted the idea that their potash project would be low cost, long life, deliver high margins, etc., etc. Unfortunately, production volumes were not enough to offset its high costs, and the business unfortunately went into administration on the 3rd of August.
That's interesting. But speaking about resources, let's look at ones in stronger financial health. And Australia's largest LNG producer and borderline star growth stock, Woodside Energy. I noticed under Golden Rule 3, earnings are expected to fall dramatically, but we've decided to retain coverage of the stock under the borderline star growth stock banner. What was the rationale behind this decision?
Yeah, good question, Ken. Well, while it's true that Woodside's earnings are projected to drop this year, it's also essential to note that growth isn't solely based on earnings in isolation. Commodity prices have also come off recent highs. So realistically speaking, it's going to be extremely difficult for the company to better the performance that it achieved in FY22, assuming all else equal. Furthermore, Woodside's strategic investments include their recent merger with BHP's petroleum business and also significant investments in projects including Sangomar and also Pluto Train 2. And these suggest long-term growth trajectories in both production volumes and its future earnings forecasts.
Well, that makes sense, Jace. But speaking about the future, the forecast gross dividend yield looks attractive at around 8% on Stock Doctor. With the business expected to boost production, as you suggested, can the company sustain its dividend?
Yeah, looking at the trend in dividends per share, we can see that it is expected to decline. And with this significant capital expenditure that the company is expected to outlay over the next couple of years, free cash flow is expected to fall quite dramatically this year. On top of volatile energy prices, we believe there is a high degree of uncertainty around the forecast dividend. And this is the reason why we removed the stock from our star income universe.
Yeah, got it. But I must say, though, many investors think that earnings for Woodside are driven by oil, but in actual fact, much of the company's portfolio is heavily weighted towards gas or LNG, making around 70% of its earnings.
Yeah, that's a good point as well, Ken. Woodside's primary production is LNG or liquefied natural gas. Now, traditionally speaking, the price of LNG has been highly correlated with the price of oil, especially in Asia. And one of the reasons accounting for this relationship is that historically, long-term LNG contracts have been indexed to oil prices for many Asian contracts that Woodside would sell into. Furthermore, energy companies also report in something called barrels of oil equivalent. And this aims to simplify the communication between the company's reserves and productions to stakeholders and also investors. The conversion between gas volumes and BOE or barrels of oil equivalent typically also is based around a ratio of energy content as well. So hopefully this provides a bit of context around some of the relationship or correlation between Woodside's share price, the oil price, and also the LNG price.
Very insightful, Jace. I know this can be quite technical, but hopefully our members have some clarity around this relationship between LNG and oil prices. And with reporting season passing, the team are assessing some emerging opportunities, one of which we spoke about recently in the stock room called Aussie Broadband, and the code is ABB. It's a key operator in the national broadband market with a market share of 7.6%. And growth is expected to ramp up with return on equity moving towards 14%. Although, Jace, I noticed net profit margins are quite slim.
Yeah, that's right, Ken. Margins are quite low, and this is due to the competitiveness of the NBN market and the potential for higher churn throughout the industry. However, earnings growth is expected to accelerate as the company expands into higher margin areas such as enterprise and government contracts, and also business connections and white labeling and wholesale connections as well. I've also noticed that despite being low, net profit margins are actually rising, and this is driven by the rollout of its own last mile fiber network. This allows the company to own that last part of the network rather than paying fees to a third-party carrier, and provides the company greater control over the speeds, connections, and also margins it's able to obtain.
And I noticed, Jace, its short interest used to be high, but sentiment is certainly improving on the stock, with short interest now declining to 2.5% over the calendar year. In addition, the stock is trading at a slight discount to fair value. So I also like to see a business with skin in the game, and no doubt Aussie Broadband meets this criteria with the managing director and co-founder Philip Britz owning 6.5% of stock. Although it seems like he has been a net seller of shares over the last year, we're not concerned because in more recent months, Mr. Britz has continued to purchase some stock.
And looking to the corporate calendar for next week, it's going to be another quiet period with no company announcements expected.
This week in Under the Microscope, we take a closer look at the initiation of star growth stock Capricorn Metals. The code is CMM. It's a mid-tier gold miner based in Western Australia, and Capricorn is a relatively new producer, having developed the Karla Winder gold project in 2021. Since then, though, the company has delivered strong cash flows, allowing it to pay down debt and improve its financial health.
That's right, Kian. The FY23 report showed a further improvement in return on invested capital, and this was due to higher gold prices. Strong cash flows also led to an improvement to its earnings quality, and this enabled the stock to meet our quantitative thresholds.
Wonderful, Jace. And given we already own gold miners such as Alkane Resources, Perseus, and also Gold Road Resources in the Star Growth universe, do you think adding another gold stock will increase concentration risk within the sector?
It's another very good question as well, Ken. Look, 4 gold stocks within a portfolio of 27 stocks translates to roughly 15% exposure to gold. Ideally, having about 10% exposure should be sufficient, but our model tends to naturally gravitate towards the most profitable companies at any given point in time. This provides our members with options depending on how comfortable they are with the risks to each of these companies and their exposure to the overall gold sector as well.
And Capricorn, like Gold Road Resources, is considered a mid-tier producer, as its current mine has the capacity to produce 110 to 120k Oz of gold per annum, almost double that of Alkane's current production in New South Wales. And the stark difference to Perseus, though, is that the company produces in Australia, whereas Perseus has assets in West Africa. And this is probably the reason why it's trading at a higher forward PE multiple compared to its peers at 15 times.
Yeah, geographical location is very important for miners. Also, Capricorn is ramping up its expenditures in FY25 with the development of its Mount Gibson project, which is why we see significant moderation in return on invested capital and also earnings per share as it enters a higher phase of investment.
But potential investors should keep an eye on the rising short interest, although it's not reached our threshold of concern at around 5% yet. There are 6 analysts covering the stock, and although the stock is trading at a discount to fair value, investors need to be mindful that consensus price targets are not very reliable for gold stocks, given the volatile nature of gold prices over time.
Good point, Ken. And also, if we look under Golden Rule 7, we can see that Chairman Mark Clark has a relatively strong skin in the game at 6% of all shares on issue.
Following the reporting season, a useful question this week is, how can investors look for emerging growth or income opportunities? Well, the Stock Doctor filter is a great place to search for emerging opportunities. And a good place to start is to run Tim's growth or income stocks with potential. Here you can sort the stocks by the strong earnings revisions or by the highest dividend yield in order to look for opportunities. Otherwise, you can build your own.
So for those that are pretty keen to look for growth opportunities, you may want to include the following fields: non-star stock, strong or satisfactory financial health, forecast ROE greater than 8%, positive forecast revenue growth, positive earnings revisions, daily average greater than $50,000, and also include a valuation or oversold signals such as the SD30 TSR, and also price to consensus target.
Yeah, after you run the filter, you can then sort by price to consensus target, for example, and then you can see some opportunities emerge. For instance, here we have Silk Logistics, Close the Loop, Austin Engineering, Premium, Dropsuit, Satire, and even RPM Global Holdings.
For income opportunities, you may want to add the following fields: forward gross dividend yield greater than 5%, positive earnings revisions, 1-year return relative to the index greater than negative 20%, then this is to weed out any of the yield traps, an average daily traded of greater than $200,000, and also don't forget to include the ex-dividend date. Then you can sort the gross forecast dividend yield. Some interesting names here include Eagers Automotive, Lindsay Australia, Homeco REIT, and also Medibank.
Yes, Stock Doctor's filter tool is very powerful. And at the moment, our research team are applying these filters and then conducting further due diligence on the outlook, active risk and management, just to see whether some of these stocks could come into our star stock universe. Thanks, Jace, for your insights. That's all we have time for today.
Thanks for having me, Ken. It's a pleasure as always.
Pleasure is all mine, Jace. And for those who have any questions on today's episode or stocks in general, please come along to our Lincoln Live webinar on Monday. So to summarize today's episode, with inflation remaining sticky, interest rates could remain higher for longer. So this will continue to put pressure on the economy and financially weak businesses. And if there's any volatility on the horizon, that could lead to share price weakness across those quality businesses. So you can use our Stock Doctor filter just to look for those emerging opportunities. Take care and have a happy, healthy, and prosperous week ahead.